We're going to go ahead and record this. So anyone who's in attendance today is going to receive a copy later on or within 24 hours of today's webinar. So let's go ahead and begin. I'm going to jump into the presentation. All right, we've already done our introduction, so let's just talk briefly about the agenda. I'm going to spend the first part of the webinar talking about what the market is like today in Phoenix, real estate-wise. Then Jeff is going to come on and he's going to talk about the investment property loans that are out there for all of you to use to become landlords, to start picking up rental properties right away. And if time permits at the end, we'll go ahead and have a Q&A and try to field some questions. So my part of this is to talk about the real estate market. I'm going to reference recent sales data, specifically from last March. That's the most recent data from Armless. Also the rental data, and then talk about a little bit about the outlook moving forward for the rest of the year. Right now, you should be seeing the monthly sales from March of 2022. Where are we at with that? Well, year over year, we're down very nominally, 2.8%, excuse me. Very small adjustment there. But compared to last month, we're over 25% as far as sales. And if you're looking at the graph and you can see my little arrow, you can see from January, it's rocketing upward, okay? So in spite of the economic data and news that you're hearing out there, we're still plowing ahead. We're still moving forward. Total inventory. And this speaks a lot to what that rise in pricing has been, because from a historical standard, we are or have been for the past 18 months, we have been at historical lows. And you can see the total inventory from last month, but I want you to put your focus towards the gray number going back to 2021. We're normally at a total inventory somewhere between 15,000 and 18,000 units at any one time out there on the market. And we're well under 50% of that. And that's causing a lot of, well, it's not causing it, it's probably the direct source of why we're seeing such rapid appreciation over the past year. New list prices, people are becoming a lot more aggressive. Look at what the average new list price is year over year. I mean, and the difference between those numbers, the median and average, if you remember from our high school math, average is taking all of the list prices and just divide it by the number of units. I'm more focused on the median price value, which would be the 470, because that's a truer representation of the middle of that distribution. But nevertheless, both of those numbers, 20 to 25% higher than what we've seen. And then here's the average and median sales prices. Again, it's the same, oh, I'm sorry. It looks like I didn't get that graphic up. I chose the wrong graphic. Forgive me, I'll get that uploaded in a bit. And then also speaking to the health of the market, distressed sales. It's not even 1%. It's 0.1% of the sales represent short sales or foreclosure or lender-owned properties. But I do want you to focus on this because I am going to show you something that might be a little distressing when we talk about the market in general. But right now we're seeing very little distressed sales in the market. And the average time on market has dropped slightly. What is average days on market? Well, that's not the number of days of, let's just say your home went on the market on Monday and then it went under contract on Tuesday. That doesn't count that. What average days on market counts is from the beginning that was listed to the time that it's closed. Now, this doesn't represent, wow, these properties, I hear they sell in an hour or two, but remember, they may go under contract quickly, but there's still an inspection process. If there's financing, there's still an appraisal process. But historically, you can look at even going back to last year, between 20 and 21, the average time on market was much higher. It was closer in times anywhere from 45 to 60 days. 32 is very robust. Now let's switch gears and look at rental data. So there's a lot of stuff going on in this graph. I'll break that down for you. But really, I want to highlight the median average lease length, or lease average for properties. And that's what you should be excited about looking how much you can get potentially for a property or what that average rent is. And also too, the amount of time it takes to market that property, get your new tenant. And you can see it's quicker than it is for selling a property. And that's because as people are unable to purchase homes, a lot of them are throwing up their hands and saying, you know what, I'm just going to try again some other point. We need to get a rental property. As much as we have a shortage in inventory for properties to purchase, we also have that inventory shortage on the rental side. Also too, this price, the median lease and average lease price amounts that you're looking at, those are going up. And I know it's a little hard to look at through this chart, but if you look at the lime green bars that are in January, February, and March, they're at the very right of the distribution for the month in this 10-year time period. But at the very right, when you look at this one, here's February, here's March, it's all pointing upward. Median and average lease prices are appreciating rapidly. So sales prices, rents, they're rising. Rental and housing inventories, historical lows. Distressed properties are low. Everything must be rosy, right? Well, here's the biggest issue in our market today, and that is mortgage rates. So if you look at this graph, this is a caption of last week's Freddie Mac's weekly survey. And you can actually go to their website and you can go back almost 30 years and you can see how rates have gone up and down. Right now, we're at the highest that we've been in, geez, Jeff, what? 2011, maybe 2012. The average 30-year fixed rate mortgage is at 5.1. Adjustable rate mortgages are pushing near 4. And unfortunately, there's, with the Fed coming on record that they're going to raise their rate multiple times through the rest of this year, it would appear that these rates in the near term are going to be here with us, and they're going to increase too. We could very well see 30-year fixed rate mortgages at or above 6% in the near term. Of course, having those higher interest rates, and then of course having appreciation sales in sales prices, we have affordability issues. So I want you to take a look at this example. This is a real world scenario that I had with a client. In September, a $400,000 home, if somebody was putting 20% down, not thinking about buying down rates or anything, no costs, 2.87, that's under 3% for a 30-year fixed rate mortgage. That P&I payment, or principal and interest payment, is just under $1,330 a month. Now, of course, on top of that, what else do you have? Property taxes, homeowners insurance, HOA if you live in an HOA. But look at what has happened in just a 7-month period. Going off of last week's average survey rate of just over 5%, that same home purchase today, that principal interest payment is over $400 more. And so when I was putting together this PowerPoint for our seminar today, I thought, well, you know what, that isn't really an accurate reflection of what the market is, because if you were trying to buy a home in September, yeah, it was worth $400,000, but how much is that $400,000 home worth today? It's appreciated 12%. So you see on the right-hand side, you see the true scenario, that same home you wanted back in September, now you want it in here at the end of April, it's almost $450,000. And now that payment, compared to what it could have been if you had bought back in September, it's over $600 higher. Then I had mentioned earlier about distressed properties. Well, right now, they don't make up a percentage of the market, but it looks like it's trending upward going back to December. It looks like we're seeing more residential properties going into foreclosure. We have a 20% increase, in fact, year to year, and that's something that we need to watch. Remember, I know when I was putting this together, I was thinking, well, when did the moratorium come off? Well, that didn't happen this year, that happened last summer, right? So this can't have, that isn't impacting this, or it could be, right? I mean, it takes 4 months to get to a point where you could get into foreclosure. I really don't think that that's the trigger. There must be something else in the economy that's pushing these residential properties. And Jeff and I will continue to look at this monthly. So what is the outlook for the rest of the year? Are we in a bubble? Is it going to burst? Are sales prices going to continue to increase, appreciate at the 30% rate, 30% plus rate, I should say, from last year? Or is there just going to be an adjustment? And we're of the belief that there's just going to be an adjustment. There isn't going to be a bubble that bursts. And we know this because one of the underlying factors from the last time that we had issues had to do with unemployment. Our rate is really, really low. In fact, our unemployment rate at 3.3 is in March is the lowest in almost 50 years. And it's also below the national rate, which was 3.6. In fact, we were one of 12 states that posted the lowest unemployment rate since 1976. We also still expect double-digit price growth. In fact, Phoenix is projecting to increase sales another 20%. In Zillow, we are the 8th hottest market for 2022. One thing too to look at, which moves in your favor, is we can look at rents and sales properties, and there's a tried and true ratio that real estate professionals have used for years to help home buyers determine if it's cheaper to rent or to purchase a home. And it's what we refer to as the PR ratio, or the price to rent ratio. It's a pretty simple formula. You basically take that median home sales price and you divide it by the median rent times 12. So I've got an example up here on the board. You had a $500,000 home. and the median monthly rent for that subdivision or city that you're targeting is $2,000. Well, here's how you'd calculate that PR ratio. $500,000, divide that by the monthly rent times 12, you get $500,000 divided by 24,000, and then you get this index of 20.8. Well, great. What does that mean? Well, according to the guidelines, if that index is 15 or less, then it's cheaper or more affordable to buy as opposed to rent. If it's between 16 and 20, then the costs are rising, and it may be a better option to rent than buy, of course. And then that's where you would look at where interest rates are and how that would impact that potential housing payment. If the price to rent is over 21, then it's definitely more affordable to rent. So what are our cities looking like? They're pushing towards renting. There's really one city based, and this is based on, we're looking at March data. There's only one city that's remotely close to 15, and that's Phoenix. But we have one city that's already eclipsed that, and that's Scottsdale. It is cheaper to rent than purchase a home in Scottsdale. And you can see all these other cities are pushing in that direction too. So the sales prices, they're projected to increase for the rest of the year. Mortgage rates will unfortunately continue, and I'm talking about traditional loan products, will remain at or above 5%, could push up into the 6s. But because of this, there's going to be less buyers and more renters. And that presents opportunities for all of us on this webinar today, opportunities for you to invest in the real estate market. Jeff now is going to talk about the financing part of this, but I just want to, before I hand off to him, tell you how I can help you. And the immediate way that I can help you, besides providing the experience that comes from being a producing real estate broker who's handled over 700 transactions, expertise in identifying true value for properties through comprehensive analysis of sales comps. But I also help my clients with their costs. So if you're selling your property, I hope you're not, because it's going to continue to appreciate, but I have reduced listing commissions for full service marketing, everything that you would come to expect from a listing agent. Likewise, when you're ready to go into the market and purchase that investment home, I got you back there too. I got you covered. I rebate a percentage, 25% specifically of my commission goes towards your closing costs. And you can see there's a couple examples there on the right. But anyway, I would love to earn your business. Connect with me on LinkedIn, and we'll set up a time to chat and talk about your individual goals. But now we're going to have Jeff talk and explain how we're going to get you into that home. So Jeff, give me a moment. I am going to stop sharing my screen. And can you try give me just a moment. Jeff, you should be able to share your screen now. Oh, okay. Give me just a moment.
Okay, everybody, thank you so much. I just want to first talk about invest in real estate without a lot of money. There's a couple strategies that we want to talk about to help you build a increase your wealth through real estate portfolio. This is a quote that I heard on an investment strategy seminar. I heard this last week or about a month ago from Albert Einstein. I just thought I would share it with you because it's pretty clever. It says, compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. That's pretty self-explanatory, and it's definitely what we're all looking to do is make additional income. So let's move forward with the next slide. Why invest in real estate? There's many different strategies associated with it. I'm going to start from the beginning, and we're going to look at some of the basic fundamentals of real estate, and we'll get a little more complex as we go forward. I refer to this process as the real estate investment waterfall, and there is definitely a starting point we will discuss. Before we do so, Rob mentioned the bubble, and I just wanted to share these two slides. They're very optimistic. The information on the left, it says housing stays strong through the recession. So over the past 70 years, we have had 9 recessions. And during that 70-year period, every single time, 8 out of the 9, except for the mortgage collapse in 06 or 08, which was really caused by mortgage related issues, housing has gone up in value. There was definitely an equity gain, 8 out of the 9. So that last recession was caused by a mortgage collapse, which is kind of debunks the numbers, but 8 out of 9. And if we potentially do even lean towards a recession in late 2022 or early 2023, the expectation is that we will have increased equity like we've had over the past 2 years. February and March, as Rob shared earlier, were both over 25%, and that's what we expect to happen for the rest of 2022. If you look over on the right, Barry Habib talks about inflation, and over here we talk about mortgage interest rates. During that same 70-year period, all 9 times that we started a recession, interest rates went down. So this is definitely a time to prepare for it. And take advantage of the market. And if interest rates are higher today than what they were, 6 months ago, we'll just know that once we hit the recession, there's a strong possibility that interest rates will go back down again. So what does that mean? That means buy, buy, buy. Okay, inflation is also another concern. If we look at the table here on the left, it says that homeowners hedge against inflation. Inflation rate is in blue, and home price appreciation is in green. We look at 2021, inflation went to 6.9%, yet the average equity or price appreciation was 18%. So even if it goes to 8.5, which some people say that that's where we're trending for 2022, the estimated appreciation for 2022 is also 24 point something percent. So we're going to increase it. And if you own the property and you have people paying rent, we're in a market where it's cheaper to rent than it is to buy because people can't afford the down payment or let alone the payment or the financing. This gives them a best opportunity for you to secure your wealth against inflation and also grow your business. Best way to start investing in real estate is to, 1, own a home. The cheapest way to start investing is to own your own home. Use your primary home. Here's the strategy. You can use your primary home's equity to buy additional properties, or you can rent out your primary home and buy another property. There's also the number 4 there. It says you could invest inside of a self-directed IRA. So there's a couple different strategies there, but what I want to point out here is we have 4 strategies to discuss that will help you build your investment portfolio. The bottom line, investing in real estate is smart because property is tangible. Obviously, they're not making more land. Okay, this is what I refer to as the investment home purchase waterfall. We're going to start off with traditional financing, and then we're going to talk about if your debt ratio may be high and you can't afford it on paper, there are different options. One might be a bank statement loan where we use the total deposits in your account, divided by a derivative based upon the bank's guidelines. Option 3 would be a DSCR loan. This is something that has been around for about 3 years, and I've helped close about 50 of them, but it's a debt service calculation ratio. We'll discuss more about that. And option 4 is land contract, but let's jump forward. Traditional lending. This option requires the most documentation. It affects your personal credit and is capped at 10 loans. Traditional lending is the best because it has the cheapest rates, which equates into a cheaper rate, generally equates to a cheaper or a greater cash flow, which is good. So that's why we always suggest that you start with your primary residence. It will give you the cheapest interest rate. If you are planning to rent it out, then you must live in it for the recommendation is 2 years prior to renting that out. Now, if you're considering renting out your primary residence, the question is, what are you going to do with yourself? You're not going to rent out the property. If you rent it out, then what are you going to do? Well, that's where Rob and I come in. We can assess the scenario and see if it's cheaper for you to buy another house and move, or if it's cheaper for you to buy another house and rent that out. So we can definitely, you want to speak with a mortgage consultant, somebody who can work the numbers and show you with effectively 6th grade math, is it to your best interest or not? Bank statement lending. Number 2, this is for self-employed borrowers who cannot fully prove their income in their traditional way, that can show enough deposits into their bank statements to prove their income. Number 3 is DSCR. We're going to talk about that next. Okay. This is a business loan. So let me start off and make this very clear that this will not show up on your personal credit. You can close in the name of an LLC, which is a big deal. People like to do that. If you have a trust or whatever, gives you great opportunity. You can use the cash received to cover your asset requirements. So let me give you an example. If you have an investment property now and you want to take cash out of that home because there's been so much equity gain, but you're already capped at your 10 property max, which is Freddie and Fannie guideline, you can't have more than 10 investment properties, then this is an opportunity where you can cash out, and the reserve requirements, it's anywhere from 8 to 12 months reserves are required. That can also be satisfied with giving cash in the loan. So the cash that is given to you at closing can satisfy the requirement. But this is a unique lending opportunity where no income is provided. You don't have to fight with the underwriter about your tax returns for 2 years. And during the pandemic, of course, things were difficult for most people, let alone the self-employed. But we can put together a program where a loan is a business loan, not on your independent credit, no income verification, no 12 months bank statements, 24 months bank statements. What we use is the rent schedule. So if you are buying a property that is currently an investment property, you can take the existing lease, and we can provide that to underwriting as proof of income. Or there are two types of ways that properties are appraised. There's the comparable approach, where they say these are based upon comparable sales of similar likeness of property, size, and square footage. Or there's an income approach. If the property were to be an investment property, this is how much we believe the rent would be able to be gained on that property. Either of one of those two sources is what we use for income. And as long as there's a positive DSCR ratio, an example is if your mortgage is $1,200 and your rent is $1,500, obviously your DCR ratio, debt service coverage ratio, is greater than 1%. So no pay stubs, no tax returns, you have a loan. These loans have better opportunities because you can secure them faster. You can get them done. I would say, the appraisal is still going to be the hardest part. We can get this thing done in 2 to 3 weeks, but with appraisers and those types of, they're so busy these days that it may take about 30 days, but it shouldn't take any longer. The investor qualifies off of the credit, income, and assets. This is traditional investments. W-2, pay stubs, tax returns, and assets are required. This is usually difficult for those who are self-employed. And I like to say for those who have crafty accountants. Bank statement lending. To better serve self-employed borrowers, this has allowed qualified borrowers to use personal or business bank statements instead of income docs for tax transcripts. You need a 640 plus FICO, and the loan to value is up to 90%, with some with no MI requirements, no mortgage insurance is required. Loan amounts up to $3 million. There's 12 months reserves requirement generally, and use 50% of deposits to qualify. DSCR has a 620 minimum FICO, 85% max loan to value. So if you buy a $100,000 house, the maximum that can be financed is 85. Gift funds are allowed. So if you don't have the down payment money yourself, but a rich relative or a friend or a business associate wants to give you funds, you can use that. This is also a loan size capped, generally of about 2.5. I do have some investors who will go up to 4 million. Cash out can be used as reserved. But the maximum cash that one can receive is 750,000 back. Business purpose investor loan. I just want to reiterate that this does not show up on your individual credit. There is an individual personal guarantee, but that does not show up on that individual's personal credit because it is considered a business loan. Rent schedule can be used to calculate income. Again, the rent schedule is the form of an appraisal, or it can also come from if there is a current rental agreement.
Hey, Jeff, I just wanted to jump in really quick to reinforce something that maybe a lot of these potential borrowers on this webinar, they don't know about. I mean, you and I are kind of used to, when we're doing conventional loans, the expectation for good pricing and all and great terms, having a FICO of 700 or higher. To get into these investment opportunities with 620 or 640, I mean, that's wow.
It's this is the full gamut. Everybody qualifies.
Yeah.
And imagine having a lower or poorer FICO score, but still not being in a position where you have to prove your income. I mean, this is a game changer. This is a game changer for somebody who can't prove their income with not only, even if you are credit savvy, but if you can't prove your income because their student loan is a big deal right now, or could possibly you've had a lot of write-offs because of the leftover COVID pandemic. Some 2 years tax returns, that's killing a lot of people. This gives you an opportunity to still buy in a hot market with aggressive opportunities for cash flow through the increased rent, but also hedge your bet against the inflation and other issues by increasing your net worth through equity gains. Quite impressive program.
Good to know.
Yes. So this chart here just talks about some basic guidelines. Obviously, the better the credit, then you can. It says here if you have a 720 FICO, which is pretty common. It's about 48% of America has greater than a 720. But if that's the case, you can put 15% down. If it goes down to 640, then you can put 80% down for those lower tiers, up to $1 million. If you got a 620 FICO, you can still buy a home with 70% down. So that's quite aggressive. Land contracts. This is another form of financing, which there's some people who are all over Instagram and they have different programs where you can buy in and they'll teach you how to buy rental properties without even owning the home. This is one of those scenarios. You find a home and offer to take over the payments, then you rent it out for more than the current mortgage. Obviously, then you're making positive cash flow. This is actually intended for property with no equity or a property in financial distress. You can buy it out of foreclosure. They can even live in the property. If the hardship is over, they just can't afford to make up the back difference from what they owed. This is a great opportunity. I'll buy it out of foreclosure. You make the payments. I now own the home, and you give me the rent, and I'll make the mortgage payments. It's kind of a short version of how that works, but it's a kind of a unique concept as well. Okay, so how to get started? Speak with Rob, and he can help you get set up with MLS access, so you can start exploring options and looking for properties. Obviously, to be conservative, we would also recommend that you have some type of emergency fund. There is potentially, if you sign a 12 months lease, you have to assume that there's going to be at least a month while you're marketing the property, if not two, where there isn't going to be any funds collected. So be in a position where you have a little bit of emergency fund. Obviously, we would recommend pay off your credit card debts. It's harder to build wealth when you're paying significant interest. If you're stuck on this step, consider Dave Ramsey's debt snowball approach. It worked for me. It's a great concept, and quick free shout out to Dave Ramsey. It's a good program. You can also leverage your primary residence to best investment for future properties. We can help you take cash out. A lot of homes in Arizona or throughout the country have significant equity gains over the past couple of years. We could put it in a manageable product that will give you the funds necessary to buy additional investments. What I would recommend is set an appointment with myself so that we can create a custom lending strategy just for you. We can review your goals and your financial situation and custom cater a program. Is it lend out your existing home? Is it pull cash out and then lend out? We have multiple options that will help you stay compliant. And Rob,
I was going to say two things. One, I think definitely talking to you is the first step, right? So that you can identify what program that is going to work out best for them. And in the case of paying off all credit card and such, we should, I mean, how often have we seen where this is a two-step process, right? Where people get their credit, get into good credit shape, so maybe they can get a better program. So they first jump off with their home, and they'll refinance their existing mortgage, and like you said, to not only get the cash maybe to purchase that next one, but most importantly to clear up any credit issues, or if you're over leveraged with credit cards, you should knock those out first, so that now you're just focused on the savings that you're going to have. You're going to put that towards that emergency fund or the future fund for purchasing another property.
That's correct. What to look for? A good interest rate makes up for a house that you might not have the best deal of the century. Cash flow is the name of the game. Positive cash flow is a must. Know your ideal market, one that attracts jobs to help increase population or desirability. You can build much more wealth from equity than cash flow. So yes, we want to help you invest into the right areas where you can have a positive cash flow, but in this market, you can build more wealth with equity than you can cash flow. So use your cash flow to buy future properties. What is the ideal house? Now, this is just 100% personal information. This is what I believe, what I look for when I buy a rental property. I like 3 to 4 beds, 2 baths, 2-car garage, single level with a small square foot, cheaper to maintain, paint, etc. I also look for low HOA or no HOA, a property with durable finishing like tile or laminate flooring, little carpet, desert landscaping, granite countertops. I prefer new construction house. That way at least has a new roof and a new AC. Back to that other, back to the property, the previous slide, I just want to add one quick item. If I'm looking at a property to invest that might be more desirable, downtown, Old Town Scottsdale, then maybe more of a VBRO type environment, then I would probably look for some other additional bells and whistles like a pool. But if I was just looking to rent out a property in, let's say, Gilbert or Chandler, where I live, I probably wouldn't want a pool. It's just something else to break, some other type of maintenance, plus the liability if they leave the gate open and someone's, some other little one sneaks in the property. So that's the way I look at it. That's just more of a personal choice. Let's talk about the real estate scorecard, median home price. Let me give you some example. This is quite, Zillow came out with data last October that said the median house price in Arizona was $425. And then it said that in October of 2022, that the expected median sales price would be over 530,000. So over $100,000 in 1 year period. And now it's even higher than that. Pricing has taken off and it's on the growth. So 5-year gains are $172,000. Positive appreciation for the forecast for 1 year is 9.57, 5-year 27%. That's better than the stock market. This is guaranteed. So that's as good as it gets, my folks.
Awesome.
All right, let me just go ahead and open it up. We have a couple of you on. What we're going to do is we're going to unmute you. Thank you for joining us again. I just want to recap as we unmute those who attended. I want to recap and say that one thing that we would definitely recommend is to set an appointment with both Rob and I. Rob can give you access to MLS where you can go in and look like a realtor and see what properties that are for sale. But maybe even before that, give me a call. You can reach me through the webinar link. You can find me on LinkedIn, Facebook. You can call me. You can email me. My website is Laux, Laux, homeloans.com. You can fill out an application there. We can get you pre-approved. If there's bumps and bruises on your credits, that's okay. We have multiple programs available. I'm a full service mortgage broker, which means I do the heavy lifting for you. Let me use my 25 years experience and my more than 85 banks and find a program for you that will benefit you financially. If it doesn't work, there's not a benefit. It's basically, when it comes down to it, it's 6th grade math and I have a calculator. I can guarantee you and put you in a position where we can save you some money.
And just so you know, and so everybody knows, when I email out the link later today or by tomorrow morning, we'll make sure that you have Jeff's contact information as well as mine. Philip, so yeah, you and I haven't talked about this particular route, but my thinking is I would prefer, and this is where, we've done our initial loan consultation, is we should see what you feel comfortable with. I would love for you to keep your existing home, and convert that into a rental. Absolutely. What we would look at, of course, is doing, if you didn't want to use personal holding or your current savings for a down payment for a new place, then we would look at refinancing, doing a cash out refinance to get you the cash that you need. For your particular situation, I believe that when I looked at you could actually, and this is, Jeff, you can speak to this too, why it's so important when you do get qualified. A lot of people think that, well, I can't carry 2 mortgages, right? And the fact is, though, is that especially with conventional loans, right? We can get that property rented within 30 days, or you have a lease that's already, while you're under contract to purchase that new home, the bank in all likelihood may not count your entire mortgage payment.
I have a lender that will not count your existing home for 6 months. So that the assumption is if you're going to sell your existing house and buy another one, rather than do a bridge loan, which fills that gap, there's a lender who will exclude your existing principal and interest, taxes, and insurance payment of your primary residence while that's on the market. So you can buy and it won't affect your debt ratio holding that other loan. I have a friend who just did this with a property. He was moving from Vegas to Tucson, and what he did was we used that particular company, that lender, so that it excluded it from his debt ratio. He had the peace of mind of being able to move his family from Vegas all the way to Tucson at his own accord when it was convenient for him, because he also travels with work. So this put him in a position where he could sell, he could move in comfortably, and then be in a position where then once he was moved out, he'd sell his property in Vegas. And as expected, he got a full cash offer in about 4 hours.
So, but yeah, give me a buzz offline when you have time, and we can start looking at that scenario for you.
Jonathan, we appreciate you joining as well. We will send you a copy of the PowerPoint so you have that available. But please reach out to Rob and I. We will assist you further and help you get set up. There are no other calls in the queue, so we just want to sincerely thank you for your time today and let you know that we do appreciate you and that there are opportunities for us to excel and grow wealth together. Rob and I take this seriously. We'll make sure that your needs are catered to, and that whatever your credit scenario is, we will benefit you and help you feel comfortable with investing in real estate and make things better for you in your future. Thank you all for attending. We appreciate you. Have a great day.
All right, thank you, and look forward to talking to all of you down the road.